are officially live on Facebook for the Tuesday edition of the Not Your Average Investor Show. This is the one that everyone waits for, the Q3 Jax Market Update, aka what the heck is going on in the economy and the real estate market. I'm your host, Pablo Gonzalez. With me, as always, in the home stadium here, the man that I affectionately like to call GC because of his genius concepts, because he knows how to generate cash flows, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Gregg.
You know, it is so nice to hear that in person from you, Pablo.
Isn't it?
Thank you for that beautiful introduction, brother.
I forget how much more energy there is when we're in person, and I also forget how much hotter it is when we're here in person.
Hey, man, just bringing the fire today.
And with this also, they call her the Magnificent because she is our community manager, handling everybody, whatever you need. Madison the Magnificent. Say hello, Madison.
Hello, everybody.
All right. And, today we're going to recap a little bit of every quarter. JWB does a client-only investor call. For the last 7 quarters, I've been a client too.
That's pretty cool.
Yeah, it's pretty
7
cool.
quarters.
It's been 7. It's been 7 of those since I'm a client. And, it's really, I call it the GC pulpit, right? It's kind of like you build up for 3 months what your thoughts are, what's happening, how can you give the most value, and you show up even more prepared than you normally are. And today we get to recap what we did there in the little behind closed doors. But before we do that, if you are listening on the podcast, which this is normally our most downloaded episode, so welcome. Hope you stick around. This thing is a lot of fun. Hope to see you again. If you're on YouTube, happy to have you. If you're feeling like trying something new, go to nyais.com, register, put it on your calendar. We're live on Tuesdays and Thursdays. It's a lot of fun to show up live because we got a whole community out here, and we honor them with what, GC?
The roll call.
The roll call. We got Madison in the chat welcoming everybody already. We got our leadoff hitter, John Henning, saying good afternoon all. We got the fairy godmother of the Not Your Average Investor Show community, Jen Filzen, saying, hey, JWB family, good morning from beautiful Monterey, California. We got Nadeem Shah from the West Coast with his patented good morning, good afternoon, everyone. We got the man everyone knows, Noah Randari. Hello, everyone. Greetings and hope you're having a great day. We got the ringmaster of the Not Your Average Investor Show community, Drew Barnhill, saying good afternoon. I like that. I like the Macho Man, Randy Savage. We got the patriarch and the matriarch of the first family of the Not Your Average Investor Show, Ken and Caroline Moline, who we salute you. You still don't have that totally dialed in.
No.
I feel a lot of
I try really hard.
Insecurity in your voice when you say
see me like ramping up for it. It's like
we got Vivian Breakus back. She's here from good morning, good afternoon. Vivian, good to have you back as well. Who else is checking in? We got Ives Richard Dole is back from Baltimore. Ives, we don't see you very often, but it's good to have you in here. It's wonderful.
Is that a new name?
No.
Okay.
I recognize it. It just doesn't show up all the time, but shows up for the big moments.
Love it. Welcome.
Happy to have you. We got our amigo, Bill Shields. Buenas tardes, amigos, with his patented bilingual greeting. Good to have you, Bill Shields. We got Mark McDermott in the house. Hello to all from Mark McDermott. Good to have you, Mark. We got Hervé Francois from New Jersey saying, what up, JWB fam? Good to have you, Hervé. Who else we got? All right, that's what we got as far as the roll call goes. GC, let's kick right into this thing, man.
Okay, we got a lot to cover.
Lot to cover. As you prepare for these quarterly updates, I know that is what is on your mind is what are the people that have entrusted me with their retirement thinking.
Yeah.
As someone who is fully entrusting you with my retirement currently, it's pretty obvious, right? Headed into a recession. What does that mean for the investments that I'm already in? And then as I'm going into a recession, the first thing that, gutturally, I subconsciously start thinking of the last time I was in a recession. I was in a recession, it was terrible for real estate.
Right.
So what does that mean? Then I'm thinking, what do I do with my money? And then I'm thinking, how solid is JWB? Are you going to run away with this thing or not?
Yeah. Okay. So you got a lot of emotions going on in your dome right now.
It's tough to be me. It's tough to be me. So, let's talk about it right now, man. So headed into a recession.
Yeah.
What should I be expecting real estate prices to drop in a recession?
Well, there is a lot there. And I think that pulse of what you all are thinking out there, what you're thinking, Pablo, is very, very palpable, right? It's very easy to understand where people's headspace is right now. If I think about where we were last quarterly call, the feeling that I had from all of you out there was just fear. Something was on the horizon. We didn't know what was going to happen, 90 days ago. But we felt like things were going to change. And that was in a very, very, very fearful spot for folks. As I think about it now, it's not only fear, there's still fear. There's a lot of volatility in the world right now. There's that fear, but there is substantial pessimism now. And in our world, in housing, there is an incredible amount of pessimism. I pulled some housing headlines, just did a Google search. And I mean, it's not hard to find a talking head who says that housing is going to crash. I mean, I pulled one from Newsweek. This just happened in the last week or so. It says U.S. facing perfect storm for 2008 like housing crash, says some economist. The nation's housing market is on a correction course. From Housing Wire, from Inman, more people than ever are asking Google, will the housing market crash?
That's an interesting data point, right? Like the idea that Google, like that everybody is Google searches is a wonderful data point to find out. Okay, so it's headlines. Headlines are stoking the flames, and people are buying it.
Absolutely. I mean, if you are not somebody who tunes into the Not Your Average Investor show, if you are just, trying to stay up to date on what things are going, you go based on headlines, you're really scared. You're scared about housing. Now on top of housing, you're also getting this recession news, right? We've had 2 quarters of negative GDP growth that for all intents and purposes means that we're in a recession, or one is coming very quickly. And you talk to a lot of really smart people and everybody sort of agrees that there is some challenge coming in that regard. So now you're reading recession headlines. Are we in a recession, right? The Fed has kind of said we are or we're not, who knows, right? But it's a lot of recession talk, and you're lumping negative housing headlines, you're lumping recession on here, and all of you, let's just not say you, right? Most people out there outside of our bubble think of recession by itself, and they think housing prices are going to crash because they were there in 2008, right? Whether they were in their primary home or whether they were investing in real estate, whether they had a friend or a family member who was impacted by it, 2008 hurts us still. There's an emotional reaction.
Yeah, let's face it, that run up to 2008 got a bunch of people that were never in real estate into real estate on that run up too, right? Yep. So like, I remember my brother was like buying a house here and there and blah, 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 blah as well. He had no, he was not a real estate guy by any means. Right? Like everyone and their cousin was like, let me get some of this.
Yeah. And then they were quickly out right after that. That train came in and left the station real quick. Yeah. So, as I think about, again, like I try to reflect before these calls and when we sit down on the client only call and today, it's like a double whammy, I feel, of really negative sentiment. And while I understand that people are fearful and I understand that people are pessimistic, we have to be committed to looking at the data, right? If there are headlines out there, and this is what I was sharing yesterday, if there are headlines, there's a lot of headlines out there that aren't based on data. We all could pull up a number of examples on that, and that's dangerous. But if there are headlines out there that actually are based on data and they lack perspective, I think that's even more dangerous. And I'm seeing a lot of that here. So what I'm trying to do every time I sit down for one of these quarterly calls, I try to make sure that I can bring the data, I can bring perspective after doing this for 17 years, can bring knowledge, experience, and bring it to you all so that you all can draw your own conclusions. And the conclusions that I think you're going to draw based on the data that we're looking here today are going to be very different than what the national headlines are saying and what the media is saying. And I want to challenge you to look beyond the headlines, look beyond what the media is saying. I'm going to try and point out some things that they're going to say, and I'm going to show you the real data. And so that's my hope and intention here today, is that we can all leave better informed, powerful to make our own decisions and not be reactive to what the talking heads in the media are saying.
Well, I appreciate it. I'm pretty sure the community appreciates it as well. So what are we looking at as far as recession means home price decline? What have you got for data there?
Yeah, I think that's a great place to start. Most people think that home recessions lead to housing prices declining, but actually the data is very much the opposite. So I went and I looked back at all of the recessions since 1978. I chose 1978 because that's when we actually have good housing data.
Mhm.
And I said, well, let's put this to the test. Let's look at all of the recessions since 1978 and let's see how housing performed. And what I found is that in those recessions, we've had 6 recessions, and I'm talking about 5 of them right now. There is one that I'm leaving out right now, which we're going to talk about in just a second. But in 5 of those 6 recessions, GDP has gone down 12.2% on average, right? The economy has been constricting, right? It's been going down, but housing prices have actually gone up in 5 out of the last 6 recessions. Not only have they gone up, they have gone up at a rate that's even higher than the 40-year average for housing across the entire country. The average for 40-year housing across the entire country is an appreciation rate of 4.5%.
Mm-hmm.
When you look at the 5 out of the last 6 recessions, housing prices across the country, housing prices in Jacksonville have actually gone up 5.6% in 5 out of the last 6 recessions. So I left one recession out there. Pablo, which one did I leave out, brother?
I mean, it looks like you left the Great Recession out there because we all know what happened there, right? Let me, I think you got a good graphic illustrating this, right?
Oh, cool.
So,
yeah.
Yeah. So talk us through this one real quick. This is, we've got 5 recessions that happened, right? January 80 to July 80. July 81 to November 82, July 90 to March 91, March 2001 to November 2001, and February 20 to April 20, right? That is the COVID recession, right? Showing 6 months, 16 months, 9 months, 8 months, 2 months worth of recession. GDP declines between 8.5%, 8.1%, 5.5%, 2.9%. COVID pandemic GDP decline of 36.2%. And Jacksonville home price appreciation during this recession being 1.8, 13.9 in that 81, 82, 0.4 in the savings and loans crisis, the dot-com boom, it inflated at almost 6, 5.9, and COVID pandemic 5.9, which shows an average home price appreciation of 5.6% in Jacksonville, which is higher than what we normally quote of that 4.6% appreciation in Jacksonville.
Exactly.
So completely in conflict with this idea that during a recession, housing pricing goes down in Jacksonville for 5 of 6. But there is that one, right? There is 2008. If we are to believe that this is an extraordinary occurrence, right? That it's not going to happen because this isn't 2 of 7 as opposed to it's 6 of 7.
Right.
Right. Meaning, I don't know if I have to explain that. I think they got it.
I got you.
What do we need to look at to feel good about the idea that this isn't 2008 again, and that's not the new norm?
There should be a very big difference as to the reasons why the recession happened.
Okay.
If you believe that the Great Recession, which is the recession that we saw housing prices actually decline by a large number, if you look at the causes of that recession, you believe that is very different than the causes of every other recession since 1978, then you could lead to a conclusion that those recessions since 1978 are more normal. And then you would look to the causes of this recession and you would say, well, geez, is that like the same recession in 2008? So in 2008, real estate caused the recession. It started by people getting loans that shouldn't have been getting loans. People were unqualified and loans were given out all the time. I was just talking to a friend who was over at my house this weekend, and I was talking about some of the things I was going to share on the show because he's super interested. And he's not a real estate guy, but I was like, do you realize like the type of loans that they had in 2008 that they advertised? Like I would get email advertisements about these loans. They were called ninja loans. He's like, nah, ninja loans? I've never heard of a ninja loan. I'm like, yeah, ninja, no income, no job or assets. Like that was the type of loan that people got in a large volume in 2008. So people were getting loans that they shouldn't have had in 2008. On top of that, we created these lending products where they would have these adjustable rate mortgages that had teaser rates. So your rate might be, I don't know, 5-6% for your mortgage, But for the first 3 years, we were going to tease that. We were going to have your interest rate be 1%. So you couldn't afford it anyways. And then you get on board and you have like a 1% interest rate for the first 3 years or 5 years or whatnot. And then all of a sudden, that is going to adjust up. And you couldn't afford it in the first place. Now you really can't afford it when it actually hits a 5% rate or a 6% rate. And there's a lot of other things that happened that led to the depths of the Great Recession and the depths of the housing crisis. But in the beginning, it was people who shouldn't have been getting loans got loans. And then those loans adjusted on people. And that is what caused the Great Recession. And that's what caused the housing crisis.
Ninjas caused the Great Recession.
Gotta watch out for ninjas, man. If you see ninjas, watch out for.
Put your money somewhere else.
Yeah, watch out, man. I don't like ninjas, man.
I mean, that is exactly what I remember, right? Like I remember, number one, every one of my friends were mortgage brokers or lenders.
Yeah. Everybody's friends where everybody became a mortgage broker. Or lender.
Everybody became a broker because all of a sudden there was this giant supply of mortgages that you could sell to just about anybody. There was this demand from the regular person, right? I talked about my brother getting into real estate and taking some lumps as well. I forgot about that story. Everybody getting in. And I remember like, as I was getting seduced to it, right? Like my buddy, Patrick Oliver, who is now a DJ in Singapore, but back then he was a mortgage broker.
Oh, what do you know? I see the correlation.
Typical story. I gotta send this to Patrick. He was like, yeah, man, I got this really good product. Like, you know, you get this, it goes up only based on like historical average of the last 3 months. So you know something's coming, so you can always sell something, this and that. And it just led to this like giant pressure cooker of knowing that at some point your mortgage rate was going to go up, even though, and you weren't going to be able to afford it, but believing that, well, this never really happens because it has never dipped. You know, housing has never dipped in a recession. Right. All this flood of people getting into it that had no business, you know, knowing about it. And then all of a sudden, when this thing hit, these, you know, arms ballooning up, are adjustable rate mortgages, ballooning up, everybody losing their job.
Yeah.
Right.
Yep.
And just everybody kind of scrambling because nobody was ready for it, right? Like the banks weren't ready for it. Institutions didn't seem ready for it. Because if you watch The Big Short, everyone was like, yeah, this is never going to happen, man. Right. Except for a couple of sharps.
Absolutely.
Yeah. I remember that perfectly, man.
Well, you know, in order to have a housing crash, you have to have a supply and demand imbalance, right? You have to have a ton of supply hitting the market.
Yeah.
You have to have very little demand, and that supply that's hitting the market has to be sold at a discount for you to see large declines in housing prices. A crash, right?
Yeah.
And all of that perfect storm came together in 2008 because, again, people were getting loans that shouldn't. What that did when those rates adjusted is that people could not afford them. That led to foreclosures. Foreclosures happened en masse. People don't realize this, but in 2008, 9, 10, 30, 40%, once you got to 2009, 2010, 30, 40% of all purchases of real estate were foreclosures.
Yeah.
Right?
Yeah,
we're going to look at some of the stats here. So if you're trying to think about why 2008's recession was different than the other ones, housing caused the recession in 2008. Therefore, housing declined in 2008. Those other recessions were not caused by real estate. Guess what? This recession that we're in or we're going to be in is not caused by real estate either.
Yeah. And you put this chart together that was kind of like the crux of the show yesterday of the client only call that showed it by the stats, right? The idea of supply and demand that we talk about all the time, months of inventory, MOI, right? Like the not your average statistic that we all know here in our community was at 16, up 15.9 in 2008 when the equilibrium is like 6 point something.
6 to 7 months.
6 to 7 months. In 2022, it's 1.4, right? So well below equilibrium. The percentage of these adjustable rate mortgages in 2008, 45% of all mortgages were a ticking time bomb. In 2022, it's 4%, right? So that means 55% of people, you know, were good to go based on they didn't need a raise to be able to afford their home in 2008. Today, 96% of people don't need a raise to be able to afford their home. Yeah. Right? Unemployment figures, 5.4% in Jacksonville. Today is 3.1% in Jacksonville. You know, 50% less unemployment, you know,
sure.
It's reduced, but I think that's an interesting set. What do I need to know about that one? I don't know how to explain that.
Well, before I go to that,
Yeah.
let me just kind of like paint the picture here,
Yeah.
right? Like I'm saying that this recession is different than 2008. That the recession that we're going into now is different than 2008.
Yeah.
But if I want to think about like if I own 10 rental properties or 15 rental properties and I'm trying to think of like worst case scenario, I tend to think worst case scenario a lot. And then before I make my decision, how could I construct a situation where I would see a housing crash? And that's really where I was coming from with these stats. And so each of these is one stat that looked terrible in 2008.
Yeah.
And all of them perfect storm wise coming together led to this terrible recession and terrible housing decline in 2008. Let's use those same stats and see where we stack up here in 2022.
Got it.
And so,
thanks for the context.
Yeah. Well, and then so getting to Jacksonville unemployment to answer your question right there, if unemployment today, unemployment at the beginning of a recession is kind of like the standard, right?
Mm-hmm.
If bad things are on the horizon, like they were in 2008, you would want more people to be employed.
Correct.
If bad things are on the horizon.
Yeah.
So today, if bad things are on the horizon for a different reason because of the recession, but if bad things are on the horizon and I'm trying to create a situation where I could see a housing crash, if I have less unemployment, the economy is in Jacksonville here specifically is better suited to withstand any potential, scenario that I would come up with. That's where you would go.
Got it. Makes sense. Then foreclosure, right? We talked about like how high foreclosure percentages got in 2010, but again, they were already at 17%, right? So this is kind of like the same as like starting, you want to start with unemployment really low. You want, the higher it is, the more from behind you're going to be already. Foreclosure was already at 17%. Right now, foreclosures are 0.6%.
Absolutely.
So basically no foreclosures happening right now.
Really, if you're thinking of trying to like, how would a crash happen? You have to have a large foreclosure percentage for a crash to happen.
Correct.
I mean, I was even shocked. I hadn't looked at the foreclosure percentage here in Jacksonville recently because I know it's way low. 0.6%. I mean, it's never been this low.
Yeah, that's negligent, right? Like negligible, right? So previous years, Jack's home price appreciation. I love that you explained this yesterday. The idea that 10% in 2008, that was still pretty high. Today in 2022, it's 17%. You explained something really profound of this idea that like high appreciation rate running up means that people have money in their home that they're not going to run from. Can you explain that again?
Yeah, well, let's go. And it's related to the previous stat that we're looking at.
Yeah.
I mean, bad things have happened to people over the last year, 2 years, right? So that foreclosure percentage rate of 0.6% that we have here in 2022 is way low. That doesn't mean that bad things stopped happening to people that caused them to lose their jobs or to cause them to lose their income or to cause them to not be able to afford their payments. But the simple fact is that home values ran up so much for the last couple of years that if you're somebody that has fallen on hard times, it makes no sense to let that house go to the bank. You can sell it for market value or close to market value and then actually make money and save your credit. And this is a big reason why we don't expect foreclosures to go anywhere close to the way they were in 2008, which is a big reason we don't see a housing crash coming.
Because you can sell it for less than retail and still be able to pay your mortgage and make money. So you're not going to just walk away from it.
Right. If I just hold on to it until the bank takes it, I make next to nothing, probably nothing, and my credit is crushed.
Yeah.
So why would you do that? You're sitting on equity right now. If people fall along hard times, they have options they didn't have in 2008.
And speaking of other reasons why you would do that is because in 2008, there was none Wall Street money invested in Jacksonville. Now there is $50 billion plus in Jacksonville, which we've talked about on the show. It's this like high floor, right? Like the idea that there is Wall Street institutional money waiting on the sideline. The moment that it dips a little bit under retail, they're going to scoop it up anyways. It's not going to go too far before they get it, is one part of it, the high floor. But the other part of it is this idea that institutional investors are ready to hold on to this thing.
Mm-hmm.
In 2008, banks had no idea that they turned into property management companies, so they had no plan for it. Today, all these banks have figured out how to do this already.
Absolutely.
So it's not going to be, there isn't going to be a liquidation. They're just going to do what JWB is doing and be like, oh, no, cool, I'll just hold it and rent it.
The big money would love for there to be a housing correction or crash or drop in values. They would love it. They have, for the first time in history, Wall Street has operationalized and institutionalized single family rental properties. That they have done it in such a lightning speed. They've done it so quickly, right? If you think about it in terms of scale, right? There are now companies that own 80,000 homes across the country. They have done the hard work over the last few years of building this thing out, operationalizing. Now they got all the capital. They know how to do it. They're set up in hundreds of markets across the country. They're at scale. They would love a buying opportunity. So that does create a high floor like we're talking about there. I should probably just clarify that $50 billion is across the entire country. That's not just in Jacksonville. That would be a lot in Jacksonville.
That would be a lot. That would be a lot. And then the kind of like not rock star statistic that is so clearly obvious, the actual statistic that looks even, maybe you would even say worse, is this affordability index. Why don't you kind of explain through
that? And I went into this saying, okay, let me look at all the stats, the positives, the negatives here. You guys have only heard positives that have shown that 2022 is so much different than 2008. But let's talk about something that doesn't look as good as it looked in 2008. So this affordability index is put together by the National Association of Realtors. And the concept is pretty simple. It's a family that earns median income in an area should be able to buy a median priced home in that area. And so for an affordability index, 100 is in that area that median income family would be able to buy a median priced home. If it's higher than 100, then that family would have more income than they would need to buy that median priced home. So you're looking at 100 as baseline. And so in 2008, we were at 135. We had more money. The middle income family had more money than they needed to buy that median priced home in the area. Well, so now we're at 99 here. And this is across the country. And this is also for the South as well, which I looked at. You look out the West, it's like 65, right? Because it's a lot more unaffordable out in the West.
Makes sense.
Right? So I looked at this and I said, wow, geez, we are not where we were in 2008. But I also looked at this and I said, baseline's 100. We are hearing about how affordability is going to cause a crash, according to all the talking heads. I mean, the data here, and this is from June, this is right, the latest data available. To me, when I look at, we're at 99 and baseline's 100, the sky is not falling from affordability. Now, it is decreasing, and affordability is something we need to be paying attention to. But I'm not bought into the headlines that affordability is causing us to crash. Right. And I don't think you should be either.
Got it. Yeah. And when I think about that affordability piece of it, I'm just like, all right, Jacksonville is at 99, South Side, right? Like if I think about any other very livable cities that I'd want to be in, and you compare it to like the Charlottes, the Nashvilles, the Denvers of the world, the Miamis of the world, like Austin, whatever, they were already way less affordable. Going into this thing to begin with, right? So it's like, who are we comparing ourselves to right now? Montgomery, Alabama. I'm pretty sure Jacksonville is a more well-rounded, economy.
And just if you're unaffordable, that doesn't mean housing prices are going to go up. Because guess what? In California, housing prices went up a ton, and they've been unaffordable for a while.
Correct. All right, we got a couple of good questions here from the community. I mean, to me, the takeaway here is economy is headed into a recession that generally, most of the time, 6 out of 7 times doesn't mean, or 5 out of 6 times does not mean home prices drop. The 1 out of 6 was because of a certain cocktail of ingredients. Ninjas were thrown in there and it did drop. But right now there are no ninjas and the rest of the cocktail is not present for that to happen. Therefore, we believe that this is going to be a 6 out of the 7 times that pricing is going to continue to go up during a recession, as opposed to 2 out of the 7 where it actually drops.
Absolutely.
Okay. All right. So let's get some questions right here. Marilyn Cotterman from Homosassa, Florida.
Home in the manatees.
It is a home in the manatees. She asks, is there still an issue with building material supply chains, et cetera, in Jacksonville and nationwide?
Marilyn, that's a great question. The answer is absolutely yes. There are still supply chain issues. This is still slowing down new construction. This is still slowing down the availability of materials for other renovations as well. It is just the way it is. And there's no use for us kind of like complaining about it anymore. It's just the way things are. And we're not building any relief in sight. We are seeing some things start to indicate that it would start to lessen. But for us, I don't want to get excited about that. So we're just challenging ourselves and our team and our builders and our contractors and whatnot. We're just trying to get through this really tough time to deliver timelines and budgets. And we hope that, at some point as we go into next year, that it won't be that way.
Okay. All right. Patriarch of the first family of the Not Your Average Investor Show community, Ken Moline asks, what would be the impact on the Jacksonville market if a significant percentage of Wall Street investors bailed out of real estate investments?
Great question, Ken. So we're talking about these Wall Street investors and we're saying, okay, I'm hearing articles. We did a show on this not too long ago, talking about how Jacksonville had something like 30% of purchases in Q1 were by investors. It was one of the highest in the nation. And the question from Michael Santorios, one of our longtime clients and referring partners, was, well, gee, should I be worried that these investors are no longer going to see value in this asset? And as quickly as they bought, they're going to be out and they're going to sell. And would my value, my assets, my rental properties with JWB, would they be at risk of a decline? So it's a great question. It's on the minds of many. A couple things to point out here. When we're talking about this percentage of investor purchases, a lot of that is investors like you, investors like me, investors like you, Ken. When we talk about investor purchases, the way they define that is if it's purchased in the name of an entity. And many investors purchase in the name of an entity. You buy it in an LLC. It's a very common thing. So that might be misleading as to who's making the decisions. Is it somebody up on an ivory tower in Wall Street, making decisions that are going to affect 1,000 properties at one time? Or is it largely smaller investors that are buying in the form of entities? It is actually not the ivory tower. It is not the Wall Street folks, because here's another stat. 2% of purchases across the country are owned by Wall Street, what we would call operators that own over 1,000 units. 2% of the industry of the single family rental space is owned by Wall Street. It's a very different number than the 30+% you're hearing about investors purchasing. And just think about what the decisions are. So for individual investors who are buying in the name of entities, which is that 30% number or whatnot that's reflected, those are decisions that are made across the entire marketplace by many, many thousands of investors that would make that decision. It's not one person. And really 2%, this is still a very young industry for Wall Street when it comes to the single family rental space. So it's a very young industry and only 2% are owned by this institutional asset class. So that was a long-winded way, but I have another thing to add there. Okay. So the question is, well, would all these thousands of investors decide that this is not going to be something that they, see value in, or would Wall Street all of a sudden decide that they're just out of this asset class? Wall Street and investors today are buying for very different reasons than they bought in 2008. In 2008, right? I'm sure your brother was a part of this, right? He probably was thinking of buying low and selling high, right? Probably wasn't paying attention to interest rates as being a big reason to get into it. And in the first quarter, which is where that stat was pulled, interest rates in Jacksonville were in the 3s and 4%, the lowest in the history of interest rates. They were artificially low, and we knew that they were going up, and investors were taking advantage of it. And the ones who were buying still have those interest rates on their mortgages at 3% or 4. And they bought it for the reason of buying and holding. They were not for buying and flipping, by and large. And that's the way that Wall Street is thinking about this. I mean, they just operationalize so they can own 80,000 homes in the country for one of the operators. They're not trying to flip 80,000 homes. They're buying this for the same reasons that you're buying this, which is to buy and hold, because there are 5 ways that real estate pays you if you buy and hold. So look not just at the composition of who is investing. Don't be scared by all these reports that say 30 or 40% of these are owned by Wall Street. It's not accurate. And then think about why they're investing. They're investing for buying and holding, which is very, very different than 2008. So I do not see a risk of everybody pulling out and saying, listen, this asset's no longer good.
So to summarize that, hearing Wall Street owns all these homes is not necessarily landing on your psyche the right way. It's actually more diversified than that. It's not like one person's going to pull a plug and it's all going to fall apart because it's not one investor named Wally T. Street. It's a bunch of investors like us.
Right.
And second, the reason why they bought these homes back then was because of price appreciation. Right now they've bought because they locked in low interest rates that puts them in a long-term buying decision-making cycle. Therefore, unlikely.
Unlikely.
All right, cool. Love it. Let's go into ties because I think it's going to dovetail nicely into this. But like Ty Oladipo's got a question. There may not be a crash of housing prices, but what are your thoughts on the rental market? Talking heads are saying rental prices will have to go down to attract enough residents. What are your thoughts on that?
I don't agree with them.
Okay.
Think about this, right? We're talking about housing price affordability, right? So with those concerns, that is going to slow the demand. That is going to slow the number of houses that are purchased. I'm not saying crash. It's going to slow the demand, which is what we want. It's what we need to normalize for the market. Where are those people going to go if they can't afford to buy houses?
Yeah.
They're going to rent.
Yeah.
For all of us here, not your average investors, JWB clients who own a hard asset like a rental property, you are in the driver's seat. Unless people decide they don't see value in buying housing, like buying or renting or having a place over their head, you're in a really good spot. And so I'm not the only person who thinks this, right? We spend a lot of time and money working with John Burns Real Estate Consulting. He's kind of one of the leading voices in this space. And I'm looking at their projections for rent growth in future years. And next year, it's almost 5% rent growth, which would be more than average.
Awesome.
More than typical. And they see it being strong in future years. And they're also predicting a recession, pretty sharp recession coming as well. So again, this would be different. I'm so glad you asked the question, Ty, because normally if you think recession, you would think rent prices are going to drop. Not the case. We don't expect that to happen here in Jacksonville.
I mean, that rings true to me just on a guttural feeling from the affordability index part of it. Because like you said, people in Jacksonville, you're not going to be able to buy a house. You're going to have to rent.
Mm-hmm.
And then on top of that, we sit in this like sweet spot of affordability where I know a bunch of people from Miami that are just like, Miami is too unaffordable and I can afford to rent in Jacksonville for, I'm still right now paying for a 1,600 square foot, two bathroom, 2-bedroom apartment. I am paying slightly less today, 4 years later in the same place than I was paying for a 900 square foot studio that I was in Miami.
That's a great example, man.
Right?
That's awesome.
So, like you're still going to get that upwards demand of people from other places that are moving to here, plus the people that can't buy houses. So I think that makes a lot of sense. So GC, recession's coming. Real estate's probably not going to get affected. Where else would I be thinking about putting my money?
Yeah, I think, to talk about what is going to happen for real estate, I think real estate's going to normalize, which is what we want, right? Like normal real estate performs at a rate of about 4.5% across the country, meaning like an appreciation rate of 4.5% across the country. In Jacksonville, it's a little bit higher than that. And people buy for all 5 profit centers and they buy and hold. And I think even beyond investors, people are going to make decisions that are more in line with how things have been happening prior to the last 2 years. I mean, the last 2 years have been nuts. So you're going to see things that are normalizing is the feel here. I think it's highly unlikely that you're going to see a significant drop in prices, but I think it's going to be important for you all to look beyond those headlines. Here's what I also know though, is that the last couple of months for us, especially as investors here, have been really kind of like a shock to the system, almost like a shock to the system. Kind of, it's not at the same level as when the pandemic hit, but that same thing has sort of happened lately, just because you're getting hit from so many angles here. For us as real estate investors, we've been really shocked with interest rates, right? Interest rates have gone up at the fastest rate in the shortest time period in the last 41 years, gone up over 2.5% at one time. So I think we're all really kind of feeling this shock. And I wanted to bring some good news to that though. For those who have been on the show, we were on the show last Thursday, we talked about how there is some relief that's coming. And there's a lot of reasons that go into this, but at the end of the day, we got a little bit better expectation or a little bit better news than expectations on inflation. And so what that has done is the market has reacted positively, and that's kept interest rates lower than what we were expecting or having a few months ago. And so for all of you who maybe who were not on the show on Thursday and who haven't taken a look at a JWB property evaluation in a while, you're going to be pleasantly surprised. The expected interest rate for JWB on all of our client purchases now is much lower. It was 6.38%. That went up from like 4% not that long ago to 6.38% in the span of a few months. Like that shock is real, but you're getting some relief. It's down to 6% now, which I ran the numbers on it. And just that drop from 6.38% to 6% on average is going to increase your cash flow about $600 a year. And it's going to increase your expected return on investment by about a half point, by about 0.5%, just like that right there. So that's a really good thing for all of us out there to see some relief. Now, I will say, we don't know where it's going from here.
Yeah.
That's up to too many variables out there. So, locking an interest rate right now that is lower is definitely to your advantage. A lot of people say that interest rates could go higher. Some are saying that they could go lower. I'm not going to make a prediction, but I do know that it's less than what it was a couple of months ago.
Definitely seems like a ray of sunshine, clouds around, maybe the clouds continue to part, but there's definitely a chance of a downpour also.
Yeah.
But what about in other markets, man? Like where else would people be thinking about putting their money, and what do you think about that?
Well, I think right now is if I'm thinking about where to put my money, you're stuck between a rock and a hard place still. We've been saying this for a little while. I think if you're looking at putting your money in the stock market right now, I ran the numbers here. So you are down about 11% in the S&P 500 index right now. And, we're of course not done for the year. So if you average that out and annualize it like we do in real estate, that's, you're down 15% annualized there. If you're thinking about the other places that people will generally put their money, if it's not going well in the stock market, usually bonds, or either government bonds or some corporate bonds or whatnot, they're not paying anything. I mean, it is really tough. Like government bonds right now are paying 2 or 3%. It is really tough to find an asset that is consistent and can beat inflation. It's tougher today than it's ever been, definitely in the last 40 years. And so as an investor, that's not where you want to be. That means you either have to take wild risks or you have to accept losing your buying power every single day. It's like giving up. Yeah. That's not where you want to be as an investor. That's where the vast majority of investments are. Obviously our investments we're not in that hard place. I mean, it's an investment that, JWB properties are expected to perform at between 11 to 12% returns each and every year. So we're beating inflation right now, and it's consistent. Yeah. So that's a big thing. But I think, the biggest challenge going forward, nobody really knows what the stock market's going to do. They don't know. It's had a nice bounce recently. It's gone up. Yeah. But I think what we can all agree on is that there's still a lot of volatility yet to come. And so if you're looking to limit the volatility, you don't have a lot of options right now, limiting volatility and beating inflation. And you got to find those assets that you can do both.
That makes sense. Something I didn't put together on yesterday's call is this idea that interest rates have been going up and they just had a dip. And that's makes a good investment opportunity right now. Stock market's been going down and people say buy the dip, but it just had a run up. So it's almost like both things put together. This short-term little run up when, volatility is coming and there's probably a bottom that's still going to hit. It's kind of like the wrong time to put money. I don't know what the answer is.
I'm keeping my money on the sidelines I have some money that I have to put in the market and it's not going in there right now.
So then, all right. So then feels like the answer is real estate, right? And we know that you got to bet on an operator. When it comes to real estate, right? Whether it is single family home or a syndication or whatever you're going to do, you got to really bet on an operator. And I think we're about to talk about the strength of y'all as an operator right now. But apart from that, we unveiled on the show on Thursday. Maybe you want to tell everybody about the very rare limited edition promotion.
Oh, yeah. So going back to interest rates here, we thought this is a really cool time for us to help out clients. Yep. That interest rate shock is real. We've been hearing that for clients. It's nice to get a little bit of relief, but if we can do something to help you guys continue with your buying plans, then we wanted to do something. So what JWB is actually doing an incentive, which for all of you on the show, that happens, like next to never. So it's a pretty cool thing. What we're doing here is we're buying down the interest rate for our clients. Now they do have to purchase a new property and they have to close on that property by October 15th. but JWB is going to buy down your interest rate. So to kind of go back to that interest rate reduction we were talking about on the evaluation, it's going to say an expected interest rate of 6%. Your interest rate is going to be purchased down, bought down. The rate is going to be lower than that. And it should save you an extra 1/8 of a point to 1/4 of a point on the property or properties that you purchase. So even better than that. So really great thing. Again, with every great incentive, there's a little bit of a deadline there. And so if you're working backwards here, you have to close by October 15th. So you have to have your ducks in a row and you have to make a decision. It's August 16th right now. So that's about 2 months. Really means you got to get this thing under contract pretty much like this week for you to have a smooth landing, to get in there and make sure that all of your documentation is approved by the bank and all that good stuff, so that you're not getting too close to the finish line. So hope you all take advantage of that. For current clients, just reach out to your portfolio manager. We do have available inventory right now, so that's not a limitation. And if you're a new client, you do have time to take advantage of this. You just got to get on the phone with my team and start to have those phone calls. We're happy to move through at the right pace, but we know that we want to get you this incentive. So happy to expedite it.
There you go. So existing client, talk to your portfolio manager. New client, chat with jwb.com, pick a time, get on a phone call, make it happen, take advantage of this. I'm a little jealous that I closed on my home about a month ago. I would not have minded this incentives. Thanks for the heads up, buddy.
Yeah, you know. I did not know. Sorry there, brother.
It's okay. I'm in it for the long term.
I know.
All right. So recession happening. Real estate is a better place to be than anywhere else based on historical performance of recessions. Unless it's this one recession that happened, we have shown that this is not going to be one of those exceptions based on the stats as of right now. And real estate is the move. But as we all know here in our community, whether you're going to be betting on a real estate investment, the purchase is just like a one-time thing. Your relationship with the operator is what's going to make that price tag and that ROI really come true. So we just want to show you the statistics of JWB as an operator, so that if you are looking into a syndication, if you are looking into some kind of other real estate, other turnkey opportunity or whatever, you can look at, this is almost like buying a home from an operator is like analyzing one stock, right? Like if I'm buying one stock, then I'm going like really deep into the company's financials, and I want them to have some kind of like strategic opportunity, some kind of flywheel, right? Like all the things that I read about in Jim Collins' books, and have a product that I really believe in. So let's get into the numbers of JWB so that you see this operator.
Yeah, and I think for those of you who are considering doing business with JWB, this is going to be great for you. But if you're considering putting your money in other places, this is like the book to follow, of the questions to ask them. I mean, these are the slides right here. And if anybody would like these slides, by the way, just reach out to Madison, let her know. We're happy to provide these slides to you guys as well. But use this. This is like your game plan for finding an operator that is worthy of managing your money for you in real estate. So
yeah, there you go. And plus, it's, this is the insider's view of the Jacksonville market. What is happening in the Jacksonville market, right? Like the velocity of the market, since this is the Q3 market update.
Well, here you go. Let's do some Q3 market update right here.
Q3 it up.
You going to do this? You're going to go through it, or am I
was just going to kind of echo everything that you said for a little while. I'm just kidding. All right. JWB stats. So far, 2022 pace. Properties purchased, 583. New construction starts, 477. Renovations completed, 160. Turnkey property sales, 492.
Yeah, lots of properties purchased. So not only are we talking about where we see the market going forward, we are putting our money where our mouth is. We are continuing to buy as many as we can. 600 is about the maximum number of properties we've ever purchased in a year. So you guys can see that if I felt that there was going to be a crash like in 2008, do you really think that I'd be buying about as many properties as I could right now? Clearly, you see that we think that this is different than 2008. New construction starts. I thought it was a great question by Marilyn asking about supply chain challenges. My team is persevering through that because we are buying a lot of properties, but unless we can get those things built and renovated for you all, it's not going to matter as far as you building out your buying plans and getting to your passive income goals as quickly as possible. So we're starting 477 homes. That's our pace this year. For new construction homes, we'll finish somewhere around there as well. A little bit less than that. Starts aren't always in the same year as finishes, but it'll be a new world record for us there as well. And then renovations, you see 160 here, just to give you some perspective there. we love renovated properties, just like we love new construction properties, because when you're buying and holding for a full market cycle, which is known to be between 10 to 20 years, everything is a renovation at some point. Your new construction properties are not new construction after the year that you buy them. And so we don't see any data to show that a new construction property over a long-term hold is going to have a better return on investment than a home that was built 20 years prior, 30 years prior, 40 years prior. So we love them both. The reason that you see 160 for renovations completed, whereas you don't see a higher number there, is strictly because of the market.
Mm-hmm.
If all we had was existing inventory, which is renovations, to be able to supply you all with homes for your profit centers and for your properties to add to your portfolio, it's a lot of P's there, by the way. Profit centers, properties, portfolio. I like it.
Please continue.
We just simply wouldn't be able to meet the demand. And so a long time ago, we started to learn how to build new construction homes, and that's what the market's giving us right now. So that's why you see new construction. And then lastly, there are turnkey property sales. Really wonderful to see. Geez, we'll have close to 450, 500 properties that are purchased by clients this year. That will be a new world record, or be right there for us. Really happy for all of you continuing to add to your portfolio.
We talk a lot about this whole idea of like aligning incentives, right? And to me, that's what kind of this slide says. The idea that you are buying 583 properties, it means that you are believing you are eating your own dog food. You're believing the thing that you're selling, right? New construction starts means that you are planning for demand that you believe is there, that you're going to continue to be selling.
Mm-hmm.
Renos completed is just kind of opportunistic, right? Like you are gobbling up whatever you can. The fact that there are not that many means that many other people are trying to do renos.
Yep.
And then turnkey property sales 492. It's just 492 other community members,
Awesome.
people like us doing
awesome.
what we do, right? So I like this aligning of incentive slide is what I would call that.
Love that.
All right. So talk to me about property management KPIs, GC.
I mean, it was so cool to have the team there yesterday. Our team and many members of our property management team were there in the room live. We've been kind of like testing out on a small scale this live audience as we do our client only calls. And so just so proud of the property management team. I mean, continue to put up incredible numbers here. So rent collection percentage over 97%, right? Our property management team has dealt with a lot of challenges, a lot of obstacles that other people would use as excuses as to why they couldn't collect rent, right? A pandemic, right? Collecting 97, 98% of rent all throughout the pandemic, continuing to do the same thing. So at the end of the day, if we can't collect rent for you guys, you're not going to be happy with your investments. We know how important that is. And so super proud of the team that we continue to collect a very high percentage there. Your average rents per property are continuing to go up, which is what you would expect. So we have crossed the $1,300 average rent threshold for our portfolio. And we now manage 4,749 rental properties here in the greater Jacksonville area. Getting close to that 5,000 number, brother.
That's a big number, man. That's a big number. So for me, this slide is market power.
Mm-hmm.
Like I think of the 40, the close to 5,000 properties. That to me is capacity that you have to be able to like do stuff like that, which means preferential treatment during hurricanes, better pricing when negotiating with builders, things of that sort, right? Like the average rent per property means that many people want to live here. Like that was much lower before. It means people want to live here, myself included, and rent collection, 97.4%, just great performance.
Yeah, man. Thank you, buddy.
Market power.
Here's some more market power, right? What do you think it's like to rent 1,200 homes in a single year?
I've only rented one at a time, so
it's a lot of work.
I'm not the guy to ask.
You're taking people's emotions. You're making sure that their living situation is what they want. I mean, it's a lot that goes into this. Our leasing team's incredible. Not only do they're on pace to rent over 1,200 homes this year. These aren't just accepting anybody off the street who wants to rent with us. Our qualifications are extremely hard to be able to rent a JWB home. And then on top of that, if somebody says, hey, I really love everything about their home and I have all the qualifications and my background's great and everything, but I'd only want to rent for a year. You know what we tell them, Pablo?
No, dog.
We say politely that, I'm sorry, we can't help you.
Oh, okay.
It would not be good for our investors. We're not like every other property management company. We're here for the win-win-win across the board. And so we only sign 2- and 3-year leases. Property management leasing team continuing to challenge themselves. So keep that in mind. You can see that in the average duration of initial lease. That is over 27 months, right where we want it to be. That leads to our average duration of resident stay, which is 4.5 years. 4.5 years is really nice for you to know that on average, you're only going to have a property turn. You're only going to have that vacancy cost. You're only going to have a new tenant placement fee every 4.5 years. That's how we save you $5,000-$6,000 when we're able to renew leases, which is a great segue to the next one. Almost 1,400 leases will be renewed this year by the JWB team. An incredible accomplishment, one that we have never touched that high of a number before. And at the same time, we are re-renting homes with substantial rent increases. We are not keeping people in your homes for below market rent. On average, our re-rents are 14% higher than the last rent rate. Okay. So if you were renting for $1,000, now you're renting for $1,140. I mean, that is substantial. And many of you on the call have experienced that wonderful call from your service teammate here at JWB. Not only do you find out your home is rented, but you find out that you got a substantial rent increase. It's pretty awesome. And then lastly here, eviction percentage, largely in line with our historical averages. 0.3% is what we're comfortable with. And that's a necessary cost of doing business. Unfortunately, when you manage close to 5,000 homes, there are going to be evictions, but that percentage leads right into, us hitting our return on investment expectations for all of our clients across the board.
I think if I would call this slide something, I would call it the ROI slide.
Yeah.
Right. Because I look at this and I'm like, the ability to keep a resident in the home is the number one driver of exceeding expectations of my ROI on my performance evaluation sheet. Right. So like, being able to rent out 1,200 shows that you can do it. Having a average duration of like an initial lease of 2 and change, like higher than 2 years, meaning that you're between 2 and 3 is fantastic. The number of re-signs at 1,300 is epic. And like, having a negligible, 0.3% eviction rate, that just means ROI. Yeah. Right. Miguel Angel Sanudo's got a question. He says, with all this great power, does JWB have any power to push property insurance down?
With great power comes great responsibility. Do we have any power to push property insurance down? I don't know what power we have. I mean, there are big power plays being made. This is an insurance company thing. This is actually a state legislature thing. This is the legal system, and the attorneys have had a field day as far as making a lot of claims in the state of Florida that simply are just not being made in other states due to the legal and the legislature and the ways that has worked. So that's been the big reason why insurance companies have had to bail out in Florida recently. And that's what's causing the premiums to have risen so much over the past couple of years. Here's the good news. The worst is over. Feel really good about that. The state legislature had a special session to correct, according to our insurance teammate. She said, I got probably 80% of what I felt like we really needed. And when you can get 80% of what you want from the legislature doing, putting a special session together, we'll call that a win. So we do feel like the worst is over. I will say this as well. If you're a client, you're mostly being affected if you've owned a renovated property for a number of years now and you've seen that increase happen. And I'm sorry that that's happened. But at the same time, if you're a client and you've owned a renovated property for a number of years, your home price appreciation has been substantial. And so if you look holistically at your overall return on investment, we told you it was going to be here. Largely, it's way up here, even though your insurance cost has gone up. So keep that in mind as well. Something else to keep in mind. If you're thinking about purchasing your next one, the dust has really settled. We have a very good insight into what property insurance costs should be going forward. So I don't have those concerns of you putting a property under contract today with the insurance expectation and seeing a substantial increase in the next year. So at the end of the day, our goal is to hit return expectations. And, we're still doing that, even though insurance costs have affected a lot of you, especially those who have held for a long time.
There you go. There you go. Shout out to Vivian, who said that she just closed on her JWB home in July. That's awesome, Vivian.
Congrats.
Happy to hear that. And Ken Moline's got a question. Can you recommend a book that explains syndications and how to set them up and get mortgages on them, blah, blah, blah? Do you have like a syndication book, GC? I put it in the chat if anybody wants to help him out.
I don't have one off the top of my head, but I'll do some digging. I'll find something for you. I'll have your portfolio manager reach out to you.
We had Dennis Shapiro with the Passive Investing Almanac is a great place to start if you want to check that out.
There you go.
Ken, it's got a bunch of other stuff. I've been reading it. Really, really, really interesting.
Awesome.
So just trying to get educated out here. Do you see that, those numbers, right? Like the market power, the ROI slide. What was the other one?
Oh man, I don't know.
Market power, ROI, and and then putting your money where your mouth is, right?
There we go.
The aligning of goals, strength of an operator. I thought you illustrated that really, really well. Before we kind of like give the final takeaways, we also know that this is the most downloaded episode every single quarter. So if you are listening on the podcast or watching on YouTube, we're super pumped that you join us. Hope that you stick around. We're pretty jovial most of the time. We're a good time to hang out around here. You're going to learn some stuff. And if you go to nyais.com, you register for one of these calls, you can show up and be part of the audience. And if not, we just appreciate you being part of the podcast. Leave us a review or share it with a buddy or, whatever you got to do. Let's summarize everything that we have learned. We have learned that 5 out of the last recessions,
5 out of the last 6.
5 out of the last 6 recessions, real estate prices have gone up. Have gone up.
Separate recession from what housing prices are going to do.
Yeah.
If anything, they'll show you that they'll go up as long as that recession is not caused by real estate.
Yeah. If by any chance it were to be the one out of 6, there was these telltale signs that created a combination of things that led to a terrible cocktail being stirred by ninjas with swords. And that's not what's happening now. We're looking across the board at the demand side, the adjustable rate mortgage side, the floor that the Wall Street investors create, the affordability that people, the home price appreciation people have baked into their homes. It is all signaling that there is not going to be a floor that drops out of this one because those cocktail ingredients are not there and ninjas are nowhere to be found in Jacksonville.
There you go.
There you go. Third, nobody knows what's going on in the stock market, right? Like it is volatile,
yeah.
Right? So the safe place to go is real estate right now, based on the previous things that we just said and the volatility in the stock market. And fourth, if you are going to be in real estate, look for the strength of the operator, no matter what asset class you're doing, syndication, single family, turnkey, whatever you're doing, look at the strength of the operator. And we just gave you a formula of having them show you if they are aligning with you, whether or not they have market power in order to drive certain statistics in your favor, and whether or not they have the performance to show that they're able to over deliver on the ROI that they're putting on a magical little piece of paper. Is that number real?
Yeah, I think you nailed it pretty well,
pat
man.
myself in the back there.
Way to go, man.
Up top. And in case you want a little pat on the back, GC's got one for you. Tell them about the offer again, man.
Oh yeah. So for those clients that purchase a home or purchase multiple homes, there's no limit to this. If you put one under contract and you close by October 15th, then we are going to buy down your interest rate. Should save you between an eighth of a point to a quarter of a point on your already lower interest rates that you see on your JWV evaluation. So this should put an additional $600 plus of cash flow in your pocket per year because of all of the recent decreases to interest rates, as well as increasing your expected return by a half point. And it's a great time to do it because we don't know what interest rates are going to do going forward. And I can tell you that this offer for us to buy down your interest rate is not going to be here for a long time. So you do have to put your property under contract. If you're working backwards, you got to put it under contract, kind of like this week is what I'm thinking, for you to be able to have a smooth landing and get in there. So for current clients, reach out to your portfolio manager. If you'd like to strike up that conversation, we have available inventory right now. If you're a new client, same thing. Get on the phone with our team, start those conversations. And also, we've got Thursday coming up, which we will reveal the property of the week. And it'll be a great time for us to look at actually what's happening with these numbers, these drops in interest rates, and how you're all going to be better off.
Love that. We got one last question from our boy, Miguel Angel Sanudo, tuning in from Granada, which we love,
Absolutely.
Andalusia. And he's asking, how do you weight the length of the lease versus rent value?
Well, Miguel Angel, everything comes down to your return on investment. And so at the end of the day, what I understand is the biggest risk to your return on investment is not me getting that extra amount of rent. The biggest risk to your return on investment is that property turning over, because every time your house turns over, you have the maintenance cost, you have the vacancy cost, and you have more tenant placement fees. And now with rents going up like they are, that potential loss to you might be $6,000 or $7,000 or more. So if you think about what our job is number one, it's to reduce the chances of that happening frequently. That's how we win for you. So length of lease is really important, because a longer length of lease leans to a longer residence stay. So that's where we are always going. I've said many times, if I knew that my residents were going to stay in my home for 10 years, I would sign a 10-year lease and I would win even if I didn't get rent increases, because I would not have any turnover. I would not have any maintenance costs, any vacancy costs. So length of lease is important, but we have to make this a win for everybody. And because you're choosing to invest in the right market where rents are going up substantially, we can get rent increases. And so it's a beautiful thing for you, Miguel Angel, and for other investors right now. But just always keep in mind that this is the cherry on top. Rent increases are the cherry on top. The biggest thing is making sure that your resident stays years and years and years. Don't get sucked in by seeing like really high rent numbers and 1-year leases. Don't get sucked in by really high rent numbers, low cost for property management and 1-year leases. You're going to lose that way because you're going to have more turnover. You'll end up spending a lot more money than if you paid for premium property management and had an average duration of residence stay of 4.5 years.
Miguel Angel approves. He says, great answer. Thanks, Gregg. That's it for the Q3 Jacksonville update. What the hell's going on in the economy episode. Tuesday, we are going back to, it is Tuesday right now. I keep thinking it's Thursday because I've done 2 shows, right? Join us on Thursday for the JWB Rental Property of the Week. We're going to break down the numbers, baby. We're going to do it. We're going to look at what the inventory looks like right now, what it looks like to get into one of these it's good deal moments with JWB. Hope that you join us on Thursday. Just want to thank the community for showing up, right? This is many of you watched the investor call yesterday, you rewatched it again today. It does not take, we do not take it lightly that people are, that you are taking an hour out of your day to hang out with us in the middle of a work day. We really, really appreciate it. GC, any last words?
It just might be the single greatest sign of the strength of our community is to know that people, our clients show up. We had 85 clients that took time out of their day to listen to the call yesterday. And a lot of those same clients are right here. You guys knew this information before we showed up because you were paying attention yesterday. You're here for all of you. You're here for the community. I think it's a beautiful thing. So thank you all for making this community so strong. Can't wait to bring the fire on Thursday, buddy.
All right. Well, it's Tuesday, so I'll see you Thursday. But on Wednesday, do me a favor and don't be average.